a year of surprises. Reflecting on 2024's market performance, 2024 was a fantastic year for investors. The S&P 500 soared by 28%. The Nasdaq, fueled by tech, surged 34%. Even the Dow Jones impressed with a 16% gain. Experts point to several factors driving this growth. The economy was strong. The Federal Reserve cut interest rates. Enthusiasm for artificial intelligence boosted tech stocks. This bullish trend caught many analysts off guard. Earlier predictions of a flat or even crashing market proved wildly inaccurate. JP Morgan, for instance, anticipated weak earnings but was met with robust corporate growth. This miscalculation highlights the inherent difficulty in predicting market movements. The strong performance of 2024 raises a crucial question: can this upward trajectory continue? Investors are eager to know if 2025 will bring similar gains or a market correction. While past performance is not indicative of future results, understanding the factors that drove 2024's success is essential for navigating the year ahead. As we enter 2025, investors are left wondering if this bull market has more room to run, or if a correction is looming. Wall Street's crystal ball expert predictions for 2025. Expert opinions on the 2025 stock market outlook are mixed, ranging from optimistic to cautious. Goldman Sachs predicts a 9 to 10% gain for the S&P 500, aligning with the median Wall Street forecast. JP Morgan, having learned from its 2024 miss, is also bullish, setting a target of 6,500 for the S&P 500. However, not everyone shares this optimism. Schwab expresses uncertainty, citing the unpredictable impact of Trump's policies. Touchstone warns that growth stocks, a major driver of the 2024 rally, might be overvalued. UBS offers the most bearish outlook, predicting a mere 5% gain for the S&P 500, barely outpacing inflation. These diverging viewpoints underscore the challenges of forecasting market performance. Numerous factors, including economic data, geopolitical events, and investor sentiment, can impact stock prices. The recent resurgence of inflation, for example, has injected a degree of uncertainty into the outlook. It is crucial for investors to remember that these predictions are just that: educated guesses. Blindly following any single expert's advice can be risky. Instead, a diversified approach that considers a range of potential outcomes is recommended. Navigating the economic landscape, GDP, inflation, and the Fed. The economic backdrop for 2025 presents both opportunities and challenges for investors. The U.S. economy grew at an annualized rate of 2.8% in the last quarter of 2024, indicating continued strength. However, inflation, while down from its peak of 9% in 2022, remains a concern. The Federal Reserve's actions will be a key factor to watch in 2025. The Fed has been cutting interest rates to stimulate the economy. However, persistent inflation might force the central bank to slow down or even reverse course. Higher interest rates can make borrowing more expensive for businesses and consumers, potentially slowing down economic growth. Adding to the complexity is the unpredictable impact of Trump's policies. His tariffs, while intended to protect American industries, can also fuel inflation. Conversely, his tax cuts, while potentially boosting short-term growth, could exacerbate income inequality and long-term budget deficits. Investors need to carefully monitor these economic indicators and policy developments. Understanding the interplay between growth, inflation, and interest rates is crucial for making informed investment decisions in 2025. Weathering the storm risks, long-term strategies, and the power of cash. While the 2025 market outlook remains uncertain, investors can take steps to mitigate risks and position themselves for long-term success. One significant risk is the potential for a market correction. High valuations, particularly in the tech sector, make the market vulnerable to a pullback. Historically, the S&P 500 rarely experiences 3 consecutive years of 20% or higher gains. The strong performance of 2024 suggests that momentum might be fading. Moreover, policy uncertainty surrounding trade and taxation adds another layer of risk to the equation. Instead of trying to time the market, investors should focus on building a diversified portfolio that aligns with their risk tolerance and time horizon. For long-term investors, riding out short-term market fluctuations is often the best strategy. Having a cash reserve is crucial in uncertain times. Cash provides flexibility and allows investors to buy assets at potentially discounted prices if a market downturn occurs. By staying informed, diversifying investments, and maintaining a long-term perspective, investors can navigate the potential volatility of 2025 and beyond.